All right, well, we'll go and get started. Hello, everybody that's joining us. My name is Grant Echohawk. I am here at the TFCU Commons here in Ketchikan, Alaska, and I'm here to begin a series. It's a four-part series that's going to help any folks that are interested in getting a business started, or just the general information that it takes for an entrepreneur to get themselves ready to open up a business. And what we're going to be talking about today to kick off the series is how to prepare your personal finances. And although this is a business-oriented series of workshops, and for new businesses, what we found is that because there's not a lot of history from your own personal business, that we have to rely on aspects of your personal credit and your personal finances to determine if let's say you needed to go get some lending, which is very common when getting a new business off the ground, that's the primary area of data that we'll be looking at. So this is where we're going to start, and we're going to cover some basics of credit, of debt, how to manage it, and how to prepare yourself as you're getting your business started to ensure that if you do need any kind of financing to get started, that you're in the best possible position to do it. And then we're also going to talk about some of the different programs and offers that not only Tongass Federal Credit Union offers, but also Spruce Root as well. As I mentioned, my name is Grant Echohawk, and I technically work for Tongass Federal Credit Union as a business loan specialist, but I also do quite a bit of work for Spruce Root and do a lot of the underwriting, general financial wellness, and business basics on the Spruce Root side to help their clients get into not only lending and financing if needed, but also get them the information that they need to prepare for getting a business off the ground. So we're gonna share a lot of that material. So as we get started, just some housekeeping. If you do have any questions, feel free to put it in the chat. Most of the folks that we're going to have are probably going to be online. It's a pretty blustery day here in Ketchikan, so probably we're going to have a lot of folks staying home and watching us via Zoom. So just put any questions in the chat. I'll get to as many as I can, and then we'll also include my contact information before the night is up. So I'll go and get started. Before I get really into the meat of the presentation, the first thing I want to do is kind of talk about real quickly the relationship between Tongass Federal Credit Union and Spruce Root. As I mentioned, I work in both roles, and I have a really unique position that allows me to work with a variety of different members of Tongass Federal Credit Union as well as clients of Spruce Root. The reason why this relationship came together was trying to find the best possible way to serve all of Southeast Alaska, to ensure that our small business and entrepreneurs here in the area are given the most amount of support to get their businesses not only off the ground, but also, even if their business is established, the additional support needed to help ensure that it is successful and that it has long-term prosperity. Another reason why these organizations were able to come together so seamlessly is both are what's called a community development financial institution. And what that is allows, and particularly with Spruce Root, allows us more funding for specific programs like this, as well as on the Tonga side, which allows a little bit more flexibility for our small business community and for the Tongass members at large. So I'm really fortunate in that I can work with both organizations, with both entities, and cater different products and or services depending on what somebody needs, whether it to be individually or as a business. So I'd really encourage for anybody that doesn't know much about Tongass Federal Credit Union or Spruce Root, I'd really encourage you to check out their websites. Both offer a lot of great services, programs, and products that are designed to help our communities, and particularly with economic development and economic growth. So with that, we'll go and get started. So where we're going to be talking about is understanding credit and debt, and particularly using credit as a tool. What I'm going to do in the first few slides is go over just basic terms a lot. I don't know where everybody's knowledge is in these areas, so I want to just kind of start at the beginning. So if you already know some of this material, this will just be a refresher. But hopefully, we'll be able to also offer more information to folks as we go through this. So I'm going to start with kind of basic terms. So as I mentioned, we're going to be talking about using credit as a tool. And what using credit means is that somebody's borrowing money to buy a product or service. The money is usually borrowed through a credit card or a loan, and to get the product, and it allows somebody to get the product or service right now, as opposed to having to get it later. And you pay it back over time, but with interest. And that's a really important piece that we'll talk about a couple of throughout this presentation, and kind of why we're putting this together. Because if we do know that people do need to that do need financing in their personal needs and their business needs. So the goal is to give people the tools, and give folks the tools to allow them to get the best possible terms, which helps ensure that as you are getting financing, that with the best terms means that there's less money, or I'm sorry, more money stays in your pocket or in your household or in your business. So that's, again, kind of one of the primary goals of this particular presentation as we talk about credit and debt. So I'm going to talk about other common terms real quick. Since we're talking about credit, some components are going to be credit history, credit report, and a credit score. Now, credit history is your overall history of all of your credit activity. So from when you first opened up your first account, it could be a month ago, it could have been 10 years ago, or in my case, probably 25 years ago. So that entire credit history is basically on the different credit reports, and we'll cover some of the credit reporting agencies or the bureaus here a little bit further down, but that's your credit history. Your credit report itself is a snapshot of where your credit file is at any given moment in time. So if I was to pull my credit report today, it would give me a snapshot of my entire credit history up to last night. If I pull my credit report 6 months from now, it's going to change. That snapshot's going to change. So a credit report gives a snapshot of your credit history, depending on when you pull your credit report. And I'll also show where and how to do that later in the presentation. And then your credit score is a 3-digit code that, again, is based on, or I'm sorry, not code, but a 3-digit number that's again a snapshot of where of what your credit looks like as of when you pull your credit report. And I'll cover more of that in detail as well. But those are 3 kind of key components of credit: your credit history, your credit report, and your credit score. And then I also want to cover some common credit products. The most common, I think, or what people use, I think, most frequently are going to be credit cards. As I'm sure everybody's aware of them: Visa, MasterCard, retail cards, etc. And then another common credit option is installment loans. So if you've ever had a vehicle, whether it be a boat, a car, or an ATV, those are all installment loans. And those are also very common use of credit, whether personal or for businesses. And then a line of credit is an option. It's not as common. I think of the different lines of credit that are out there, a home equity line of credit is one that is used probably most frequently. And that basically is a long-term loan with a maximum limit that can be used and repaid and reused over a specific time. So a line of credit, a home equity line of credit, means you're using the equity in your home to basically borrow against. So that is for homeowners. That's another option that's available to them. And then the mortgage itself is also something that is a lot of folks take advantage of, and that's usually referred to as a home loan. So those are just some of the terms that we're going to be using throughout this presentation. And then the basics of understanding your debt. A couple of different things that you want to know as you're looking at your debt and looking at your credit and trying to make sure it's working for you is making sure that you're knowledgeable about who you owe, how much you owe, how much the payments are, when the payments are due, and other important facts about your debt. And a lot of that's going to be available in your credit report. So I'll cover that. That's again, we'll be covering that a little bit further on. But one thing that's really important, as I mentioned earlier, is that when you do use credit to finance something, to get financing, is that it is going to be more expensive. And so again, the purpose is to, it's going to be more expensive in the long run due to interest. So the purpose of this presentation is to, again, put you in the best possible position so you get the best possible terms, which if you're, again, personally or in business, that's going to help you out in the long run. And then when I talk about debt, a lot of people refer to good debt or bad debt. I tend to look at debt as, can it be overall very helpful for you, or can it be hurtful for you as far as whatever you want to accomplish? Because again, interest rates can vary quite a bit. So again, we want to put you in the best possible position. So in general, and again, when it comes to debt and credit, we talk in general terms, but in general, business loans are really beneficial because the goal of a business loan is to leverage that loan to start a business, increase a business, or expand a business, which is the intent is to then get revenue from leveraging those funds to not only pay off the loan, but then have your own business to bring you into decades and years into the future. Mortgages are also very, having those assets in a mortgage on an asset that often appreciates over time is also something that is very a worthwhile investment. Again, everybody's needs are different, so it's worth looking into, but speaking in general terms, mortgages are very beneficial. Student loans, when we look at student loans, the thing about them is if they can put you in the position to where you can expand your knowledge, give you more information to help you start a business or go into a career that helps you, lead to prosperity. That's something to keep in mind. But again, as with all things, even though there may be benefits, you want to thoroughly look at the terms and conditions, make sure it works, it's for you. So business loans can still be student loans can still be very beneficial. And then credit cards can be beneficial if you pay it off every single month. And that's something that's really important. A lot of folks here in Alaska, a lot of folks have mileage credit cards and take advantage of it. And so the goal, if you have any kind of point or mileage or cashback credit card, is to make sure that you do not charge or do not use the credit to the degree that you cannot pay it back within every single month. Because again, that interest does not only adds to that balance, but it compounds upon itself. So credit cards can be, if well managed, can be beneficial for you. In my case, I do have a mileage card, and I do take advantage of it wherever I can. And then on the flip side, again, credit cards right at the top for those reasons I mentioned. If you do not pay it off every single month, or if you find yourself that you are using more than 30% or really maxing those credit cards out, that's usually not a good position to be in. And so I actually will cover some debt reduction techniques later in the presentation. So credit cards can be beneficial, but they also can be something that you really have to pay close attention to. Car loans, our vehicles are needed, but they are a depreciating asset. As I'm sure everybody knows, as soon as you drive that vehicle off the lot, it depreciates in value quite a bit. So it's just something to keep in mind. And as you're looking at vehicles for the long term, making sure that you're making decisions that are going to be beneficial for the long term, considering the fact that that asset is going to depreciate. Store credit cards and furniture loans. They're out there, and in general, they have very high interest rates. So it's something that you really have to be careful with these, and particularly with furniture loans. Generally, because of the interest rates that's involved, if there's a way to save up for it and buy the furniture later on, once you have the money, to try not to go into debt with these ones, again, because of that interest rate, it's usually, if possible, that's a better way to go. Personal loans, there's nothing necessarily wrong with a personal loan. I've used them in my life, but the interest rates, because they are unsecured, can also be a little bit higher. But it's something that is for every person to decide what's best for them. Payday loans are the ones that are extremely risky. The interest rates on these are very tough. I don't see a lot of those in the folks that I run into, but just out there as something to keep in mind. But in general, any debt that overextends you is not a debt that you generally want to take on. Things happen, emergencies happen, but if you do have some opportunity to consider the debt that you're taking on, and if you find that you can only make the minimum payment on that debt, then that probably means you're pretty close to being overextended, and there may be worth looking into some other options. So just something to keep in mind. And if anybody in the audience has any questions, just raise a hand. Okay. So I covered this a little bit when it comes to taking on the debt, but when using credit, a rule of thumb with credit is you use credit for your needs rather than your wants. Okay, if you need it, then that's the time when you do use a credit card or other credit means. If you need the money to start a business, that's a good time to use credit. If you need it to purchase a home, that's a good time. But so just some things to think about. Ask yourself, right from the beginning, is this a need or a want? If it's a want, usually better to save up and pay for it in cash. Will the item last longer than the payments to purchase it? I'm going to go back to furniture loans or furniture cards. Sometimes it's going to take you longer to pay off a large furniture purchase than that furniture is even going to last in a household. So you have to keep that in mind. Again, everybody's circumstances are different, but in general, you want to make sure that you're not continuing to pay for something that you no longer have access to. And then you want to think about how much do you have to pay to borrow this money? So the monthly payments, and then how will those payments impact your household budget? And again, if you are in the position to where you can only pay the minimum on a new debt or all of your debts, then that means that probably before taking on any more debt, you'd want to get what you have paid off, or open up some revenue for some cash flow for you in your personal finances to account for emergencies, or the washing machine dies, or your vehicle needs new tires. Things happen, and so you don't want to put yourself in the position where as things come up, you're already overextended. So just some things to keep in mind. And then why does all this matter? And this is going to go back to what I put on the screen is it's a truth in lending disclosure statement. As a consumer, if you take out a loan, a financial institution is going to go over this with you and show what, and I'm going to just go on the left, what the annual percentage rate is, what the overall finance charges are going to be over the life of the loan, what was the amount financed, and then the total payments that you will have as a consumer after you've made all your payments, assuming you made the minimum payment throughout the life of the loan. And so as you can see, in this example, a 7.37% APR, annual percentage rate on the amount financed. Oops, I just made that get all big. Sorry about that. The amount financed is 138,000 and some change. You'll see that you're paying more in interest than what you actually financed, and that's not too unusual on a mortgage. This is actually the example is a mortgage, but ultimately, This is the highlight that in this example, a 7.3 annual percentage rate, the better your credit score is, then and other variables helps reduce that annual percentage rate, and or if it's on the flip side, can increase the annual percentage rate if the credit score is a little bit lower. So again, the reason why we were talking about this is over time, especially over a lifetime, a little bit of an interest rate break or an interest rate increase can drastically change your personal household finances and finances for your business if you do go into business. So just something to keep in mind. Oops. Okay. Then another thing I wanted to touch on before I go into more of the nitty gritty of credit reports and credit files is something that some people have an aversion to credit in general, particularly here in Southeast Alaska. A lot of folks can actually do a lot of their business in a cash only basis. There are industries where fishing, I think, is a good example of, and some art and things like that. There is, they can operate as cash only for a lot of the things that they do. And some people do have just a general aversion to credit and going into debt, which is understandable. It can definitely get you into trouble if you do not take into consider some of the things that when it comes to managing your debt, managing your accounts and things like that. But the disadvantage of having no credit file or a limited credit file is that creditors won't have much to go on if there is a time where you do need to finance something, to finance a vehicle or finance a boat or finance a house or even finance a business. So by making good, well thought out credit and debt decisions, which aren't necessarily going to put you in debt for the long term, because again, you can use, let's say, a credit card and use it for the month, and as long as you pay it off every month, the credit reports, they don't care what is the amount that you used and the amount that well, let me rephrase that. When it comes to the kind of the most important things are making sure that you pay that bill every single month. And so if you do charge $200 and you pay it off every month, then that's just as good as any other payment. So keeping that in mind is that you can still build your credit and increase your credit score without going into long-term debt if you do have just a general aversion to it. But as I mentioned, not only does it, with not having a robust credit file to go off of, it can make it harder in getting credit on a loan with favorable terms. And I want to stress that, and kind of just to reinforce what we've talked about a couple of times already, is that a lot of financial institutions will still lend to you, but the interest rate might be a little bit higher. And so the goal is to help you get the best possible terms. Sometimes renting an apartment can be a challenge. Sometimes cell phones can be a challenge. Some jobs without a credit file. A lot of us that work in the finance industry, the credit report does help with ensuring that gives the employer enough information to say that working with money and working with finances, that, let's say, someone like myself is likely to make good decisions. And that's common for a lot of different employers. And then even utilities and things like that can impact deposits and things that ultimately might cost a little bit more just by not having a credit file. So now we're going to talk about the credit reporting agencies and the credit reports and the credit files and how it all fits together. So there are three primary credit reporting agencies that all creditors use, and they are TransUnion, Equifax, and Experian. And one thing to keep in mind is that federal law requires each of the three nationwide consumer credit reporting companies, those three, to give you a free credit report every 12 months if you ask for it. 100% free. You don't have to sign up for anything. You don't have to sign up for a monthly subscription to anything. All you have to do is you have really two primary options that I would recommend is contact the credit bureaus directly and ask them for your free credit report. What I use is annualcreditreport.com. And the reason why I use this and why it's recommended by different financial wellness folks and financial institutions is because annualcreditreport.com is endorsed by the Federal Trade Commission, and it is kind of a more of a no frills way to access your credit reports. You can access all three credit files. If you can get TransUnion, Equifax, and Experian. They don't offer a lot of trying to sign you up for other things that some of the other services might offer, and it's just it's safe, it's secure. Again, it's the one that I use, and as a matter of fact, I just pulled my credit file I guess about a month ago, and there was an error on my file. I disputed it right from the website, and I got a response back. They corrected it, and we found out, they found out what was going on. Something was just on my file that was impacting my overall credit report, and it was incorrect. So they investigated it, and they had it removed. So this is a great resource to not only understand and see your credit report, but also you can make corrections if needed. So again, annualcreditreport.com is the one that is recommended and is the one that I use, the only one that I use. So credit scores, as I mentioned, the credit score is a snapshot. They take a snapshot of your credit report as of that day and assign a three-digit score, and the number is based on information on your credit report, and it just, again, it helps different financial institutions and creditors and everybody else kind of give a prediction on the likelihood of your ability to repay that debt and overall risk in that debt. And that's ultimately what financial institutions are looking at, or all creditors is trying to reduce risk as much as possible. And so that's why a higher credit score does help with that. And as I mentioned, people with higher credit scores are likely to present lower risk to creditors. And who uses credit scores? Financial institutions, some landlords, utility companies, some cell phone companies, insurance companies in some states, employers in some states, and state agencies or affiliated organizations. So it's pretty common use for navigating anything from professional to financial, the professional and financial landscape. So the credit model, the credit scoring model I'm going to look at is FICO, and FICO is the most common. There's a couple others out there, but FICO, I think, is the industry standard. And before I go into the different scores, I want to go off to the left where it talks about what makes up your FICO score. And as you can see, the largest section of that is your payment history. And I cannot stress this enough. As I mentioned, you don't want to put yourself in the position to where you can only make a minimum payment. But whatever that payment is, it is absolutely critical that you make that payment every single month. And as long as you do that, then that's going to take up the bulk of your credit score, since it is payment history, good payment history. And then when it comes to reducing the length of having to pay that loan back and the interest on it, wherever you can, pay extra, wherever possible. So that's the first thing. 35% is payment history. The next is the amount owed. So 30% of that, and that comes down to that comes down to, as we mentioned, or I mentioned earlier, you don't want to, or it says actually right here, your credit utilization rate keep below 30%. Essentially, if you are in any kind of debt, you don't want to max out that debt, and this is particularly true with credit cards. So if you have a $5,000 credit limit, you know, you don't want to bring it up to maybe about 30% is, was that about $1,500? You don't want to extend beyond that. The higher you go into debt relative to what your credit limit is, when it comes to scoring, it can reduce your score overall. Well, if you do have available credit and doesn't show that you are using up all your credit, then that actually helps you. And then length of credit history is next. New credit and credit mix is the other two components. And credit mix just means the types of credit that you have, like if a mortgage, an installment loan, credit cards, a variety of different credit options. Again, that shows a management of your finances. And then real quickly, the different scoring, 800 to 850 is exceptional, 740 to 799 is very good. And in those ranges are generally where you're going to see the best possible terms with any type of loan that you get, whether it be a personal loan or a business loan. So that's when you're in pretty good shape. Every financial institution is a little bit different. It depends on different offers, so you definitely want to research those. But by and large, you're in pretty good shape when it comes to the best possible terms within that kind of that range. Good is when you're in the, that's where I think a lot of folks just generally fall in the good and very good range. So you're still going to get pretty good terms. And when we start getting into fair and poor, that's when your terms might be less desirable if you do need to take on some debt. So again, our goal of this presentation, whether you use it for personal or for starting a new business, is to help you get into the very good and the exceptional range, so you can get the most out of your any financing that you might need. So how to build, repair, and maintain credit. You know, there's a little bit of maintenance required, but it's not too bad. So first, as I mentioned earlier, get and review your credit reports. Go to annualcreditreport.com. You can take a look at your 3 different credit files, make sure they're accurate, and get a good snapshot of where you're at. And some, you know, make a plan on if you want to increase your credit score. A lot of it has to do with just, again, make those on-time payments and make sure that you're not overextended in debt. You can dispute and correct any errors. As I mentioned, I just went through that. Pay all of your bills on time, and as agreed, always make at least the minimum monthly payment. If you can pay more, and if the loan allows you to pay more, which most do, then by all means, pay more. But at least make the minimum monthly payment. Use as little of your credit limit as possible, as we discussed. Use a credit building strategy, which I'll talk about some of those here a little bit later. You can also keep old accounts open if you can. Credit history is an important part of your credit report. So if you have an account that you're not using, but you have a really outstanding payment history on it, and even if you're not using it, as long as you manage it and make sure that you know, nobody else has access to it, it's secured and all that, there's really no reason to close that account. So it's just something that sits there, and it will your credit history will stay for 7 years on just on your credit file. So just one thing to keep in mind as you are managing your credit file. Only use credit if you need it. Again, if it's a need and not a want, that's when you want to use credit. And you can negotiate different terms depending on the type of debt that you have, whether it be a credit card is probably one of the most common. But if you're, you know, it's wherever you have your money held, it's sometimes worth a while just to give them a call and say, hey, are there any offers available for me? So that sometimes is an option to keep in mind. And then building credit. So there's a couple of different options for building credit. So it depends on, again, everybody's circumstances are unique. So I'm going to, again, speak in very general terms, but if you're starting with really no credit file at all, then it can be difficult, or if they had credit challenges in the past, it can be difficult to get a traditional loan or credit card. But luckily, lots of financial institutions offer what's called a secured credit card, or a credit building loan. Here at Tongass Federal Credit Union, both are offered to the members, and these are just really great products to help someone build their credit and or help repair their credit. They're very low risk, and they're essentially is you use your own funds to secure either the credit card or the loan, and it's something that here at Tongass Federal Credit Union, anybody will be happy to assist you with that if you're interested, but those are a couple of options available. As sometimes, again, you can become an authorized user on an account. Everybody's circumstances are unique. That is just an option. You do want to make sure that is thoroughly investigated, make sure that everybody in that agreement it works out for everyone, but it is an option. It's similar to being a co-signer. And you can also apply just for a regular credit card. But again, make sure you don't utilize more than 30% and always pay it off every month. That's the best advice I can give you. Pay off that credit card every month. And then you can also helping to make large down payments and negotiating with basically allowing that down payment to help you negotiate what different terms are sometimes possible. Of the options that when it comes to building, repairing credit, I would say if there are any struggles with getting, let's say a credit card, I would strongly recommend reaching out and looking at the secured credit card or the secured loan. And then the next thing I want to talk about is actually helping someone get out of debt if you want to do that. And again, if you are looking at opening a business, if you are looking at getting financing for the opening of business, your personal credit carries a lot of weight if you're a brand new business owner. Because again, we do not have any historical data off a business. So we look at your credit file, we look at your financials, we look at your W-2s and your pay stubs. Sometimes as you're going down and trying to get your business started, you do have to do preliminary work with your own credit file. So I'm going to talk about a couple of different methods. First, what's commonly referred to as a snowball method. And how this works is you list all of your debts from smallest to largest. You focus payments on the smallest debt first to pay off that debt. And then once that debt is paid off, you use the funds freed up to add to the next largest debt. So this is an important component. So let's say you're able to pay $300 a month on your smallest debt. You get that paid off, and that is a great feeling, by the way, for those that have paid off a debt. You get that paid off. Well, you've already budgeted that $300. So if the goal is to get yourself out of debt, you then take that same 300, move it to the next largest debt on top of whatever payments you were already making. So that's the most effective way to get yourself out of debt using this method, is you make sure that you continue to whatever money you had budgeted, you continue to move it to the next debt. You just keep doing that, and you basically keep moving that money from the smallest debt, get that paid off, to the next smallest, get that paid off, to the next smallest, get that paid off. And you just keep doing that till the debts are paid. Now, in my life, I have used this method because there's something just fantastic about the instant gratification of getting one of these debts paid off. It feels great. So I have used that, but there's a caveat to this. And this is where we're going to go into the avalanche method. The avalanche method is similar. You list all of your debts from largest to smallest interest rate, not how much you owe, but on the interest rate. And then you make the minimum payments on all debts, but put whatever extra possible to the debt with the highest interest rate. And then once that is paid off, you use those funds that you had already budgeted money to pay off your debt, that debt. Once that debt is paid off, then you move that payment over to the next highest interest rate. So it really depends on your interest, or for, at least for me, when I'm managing my own finances, I will use the snowball method if all the interest rates are all within the same ballpark, if they're all in the same family or neighborhood rather. But I will use the avalanche method and focus my payments on the highest interest rate. If I have an interest rate, if I for any reason had taken out debt on something that's a higher interest rate. I think a good example is I did do a little bit of quite a bit of traveling during the summer. I did use my credit card more than I normally do. That was the highest interest rate debt that I carry. So once I had the extra money, that's the one I paid off. And as a matter of fact, I just happily paid that off with my last payment. And that's because I know that the longer that money sits on that debt, the more interest it's going to accrue, and the interest on a credit card compounds upon itself. So the longer it sits there, the more difficult it is to pay off. So I take my highest debt. That's what I focus on. And so the other, just real quickly too, on credit card payments, how credit cards charge interest is what's called an average daily balance. And what that means is that at the end of the bill cycle, a credit card, what they'll average out what your balance was on day one, on day two, on day three, and at the end of the bill cycle, they'll take that average, and then that's what they'll apply the interest rate to. So just something that I started doing years and years and years ago is I always make my credit card payment the very instant it becomes available to make the payment for that bill cycle. So if my credit card prints on the 1st, I don't wait till the 25th to make that payment. I pay it on the 2nd. And what that does is that immediately reduces my average for that bill cycle. So at the end of the bill cycle, I'm charged a little bit less interest. It may not be much on any one bill cycle, but over a lifetime, I'll take that extra couple $100, whatever it amounts to. So just, again, that's just my own personal practice. I do this specifically with credit cards. I know I have to make that payment every month anyway, so I just move my payment to the very first day I can after that bill prints. And that lowers my average for that bill cycle, which means that there's less interest charged to me because my average is lower. So just another thing to keep in mind. So that was the snowball method. Use that if your interest rates, or at least I use that if my interest rates are within the same neighborhood. Well, I'll use the avalanche method if I have a debt that has a very high interest rate, just to get out, just because the longer that sits there, it becomes harder to pay off. So and then the last thing to keep in mind is there are options of debt consolidation. And so debt consolidation can happen in many different ways. You can take one of your existing credit accounts and take your higher interest debts and move them to an existing credit account. Some accounts will charge a balance transfer fee. And that can vary. And so you want to do some research and see how much you want to transfer, how you want to use it, make sure that it's going to benefit you in the long run. And then another option is to take on a new debt with the sole purpose of using it for debt consolidation. Let's say an incredible interest rate, and the balance transfer fees are in good shape, or whatever mechanism you do it. The only way this works, though, regardless of what you decide to do, and again, you'll want to look at both options critically and make sure it works, whichever one you decide works for you. But the only way this works is if you don't use those other accounts once you paid them off, or once you move those balances over. You lock them up in the safe and you let them sit there, and you focus your payments on however you use this debt consolidation option. And so that's going to be with whatever mechanism you choose to use, if you don't stop using your credit that's available to you, then neither one of these are really going to work as well as you would like. So that's rule number one: stop using your credit and then use one of these other methods. And so that's it for my presentation. Again, I do want to just remind everybody that I am a business loan specialist with Tongass Federal Credit Union and Spruce Root. So you're welcome to contact me directly if you have any follow-up questions around different financing that's available to small businesses in the area, or if you have any questions about your personal credit and how it could impact different financing that's options that might be available, or if you are a small business and looking to expand and want to look at some options, again, between Tongass Federal Credit Union and between Spruce Root, I have a large, basically quite a few options available to cater a product or service to your needs. So definitely keep that in mind. But does anybody have any immediate questions? Anything in the chat or from our esteemed audience?
I've asked in the chat, I haven't received any responses yet. Anyone in the audience?
Yeah, that's on the end.
Not particularly. I enjoyed the presentation though.
Oh, good, thank you. Yeah, thanks for stopping by. It's great. And then would you mind dropping my email in the chat?
Sure, let me do that now.
Yeah, G Echo Hawk. I hope this was helpful. Again, this was not big on the business side, but the next three presentations are going to be all business. I think the next one is writing a business plan, if I remember correctly.
Thank you for the presentation.
So we'll help out there too.
I look forward to that one.
Oh, yeah.
Yes.
Yeah, it's actually a lot of fun writing a business plan.
Yeah.
And the nice thing about it is it's not just for, you know, a lot of folks, they put together a business plan because they do need financing, and the financial institution will want to know that they've done their due diligence. And so the business plan helps with that, but it also helps the individual solidify, you know, what they want to do, make sure they have all the information. So it's really helpful for the business owner, as well as anybody else that's interested in their business and kind of what their goals are, and also the financial institution. So it's a really helpful document. So it's really handy.
Just a note for those who are online, I am unable to hear your audio if you are trying to speak. So if you can just type in your question or email Grant directly with the email address that's in the chat.
Interest rate stuff is pretty rare.
Okay.
Yeah.
No one's responded, but I do have your email address in there for them.
Great.
So we will sign off now if there's no questions.
All right.
And thank you for joining us.
Yeah, thanks for stopping by.